Welcome to the research desk. Imagine you possess absolute foreknowledge of a company's fundamental performance. You know exactly what it will earn next quarter, down to the final cent.
Which is impossible, obviously, but as a thought experiment, right?
Right, as a thought experiment. You allocate your capital based on this perfect certainty. And yet, 3 months later, your portfolio is entirely decimated.
Because you sized it wrong.
Exactly. Because raw information, divorced from a rigorous mathematical framework for sizing and risk, is just noise waiting to destroy you. We arrive today at the culmination of our analytical series. Over the course of our previous discussions, we have dismantled 7 distinct conceptual frameworks.
And today we're attempting the definitive synthesis, the 7-step decision engine.
Yes, it is the definitive culmination. We are testing if information edge, properly sized, compounds into an inescapable mathematical advantage.
The intellectual journey to this point has been pretty formidable. I mean, we've traced a direct historical lineage starting way back with Claude Shannon's foundational 1948 work at Bell Labs.
Where he first defined information capacity in discrete bits, yes.
Right. And then we moved through John Kelly's 1956 formulation of optimal capital wagering, and finally to Edward Thorp's translation of those pure theories into the ruthless domain of financial markets.
The absolute risk domain. And the historical arc we're presenting attempts to demonstrate a singular thesis.
Which is that an information edge, when properly measured and sized, automatically compounds into an insurmountable mathematical advantage. But I have to ask, does synthesizing 7 disparate mathematical instruments into one sequence actually work?
That is the central question we must resolve today. I maintain that the unified 7-step information edge protocol effectively bridges the treacherous gap between raw knowledge and mathematical sizing.
Or does compounding all these statistical assumptions create a fragile system, one that is highly vulnerable to data decay and execution failure?
I argue it eliminates failure. It standardizes the measurement of uncertainty across any domain. I mean, every single decision under uncertainty shares the exact same skeletal structure.
You observe a system, form a belief, and commit resources.
Precisely. You observe a complex system, you form a probabilistic belief about its future state, and you commit finite resources. The quality of the decision depends entirely on information quality, not human intuition.
Well, I approach this synthesis with profound skepticism. As we've discussed before, my position is that assembling 7 layers of sophisticated mathematics into a continuous sequence creates a highly fragile system.
Fragile how? The protocol serves as an infallible filter. If you skip measuring causality, you hedge the wrong variable.
Fragile because the very rigor you describe is what makes the system brittle. The engine demands pristine, stationary data environments.
But if you skip tail stress testing, you discover correlation at the exact moment of maximum market panic. This system converts raw uncertainty into a strictly sized, stress-tested position.
Assuming the inputs are flawless. But if you feed stale entropy estimates into it, or an extreme value theory model that lacks sufficient historical tail observations,
the math adjusts for the sample size.
it adjusts, but it doesn't create truth from garbage. If you put bad data into an elegant mathematical engine, you do not get truth on the other side. You get precise nonsense.
I disagree that it's nonsense.
The greatest risk facing any capital allocator is the illusion of complete safety. An engine that outputs a position size to the second decimal point based on sequential statistical derivatives invites fatal overconfidence.
To determine if the engine is truly fragile or if it systematically eliminates failure, we have to move from theory into practice.
Fair enough. Where do we start?
We will begin with its most rigorous application, highly liquid single-stock equities, because the underlying mathematics, they don't care about the asset class. They only process the structure of the information.
So we're walking through the protocol sequentially, using NVDA as our worked example.
Exactly. Step 1 requires us to observe the system and map its phase using Shannon entropy.
Let us ensure the mechanism of Shannon entropy is perfectly clear here. In thermodynamic terms, entropy measures disorder.
Right.
But in information theory, as Shannon defined it, entropy measures the degree of surprise or uncertainty in a signal.
That's the crucial translation.
So if the market's expectations for a stock's future movements are wildly divergent, some analysts projecting massive growth, others projecting total collapse, the entropy is high. The system is disordered.
Exactly. And in our current analysis of NVIDIA, the entropy of the forward revenue estimate sits at the 18th percentile globally.
The 18th percentile.
Yes, and the derivative is actively falling. This mathematically defines what we call phase 1 compression.
The information environment is narrowing.
Precisely. The market consensus is forming incredibly tightly around the AI infrastructure build-out narrative. There is very little surprise currently priced into the options market or the analyst models.
But a falling entropy derivative implies that predictability is rising, and it relies entirely on historical price series and options market implied volatility.
Which is a valid measure of consensus.
This is exactly where the fragility begins, though. If the market is systematically underpricing a latent catastrophic risk, that phase 1 compression is not a signal of safety.
It's an observation of state, not a guarantee of safety.
It is a coiled spring. It is merely the quiet before a structural fracture. Low entropy in a complex adaptive system often indicates herd behavior, not fundamental truth.
That is precisely why we do not stop at step 1. Step 1 merely defines the battlefield. Step 2 requires measuring our specific edge against that herd consensus using Kullback-Leibler divergence.
KL divergence.
Yes, KL divergence calculates the exact statistical distance between two distinct probability distributions. We are not relying on the market's implied distribution.
You're measuring the distance between consensus and your own model.
Correct. We measure the distance between the consensus analyst revenue distribution and our own proprietary model, which is informed heavily by Taiwan Semiconductor Manufacturing Company's capital expenditure data.
TSMC CAPEX.
Right. The KL divergence between those two curves measures 0.8 bits. This is a massive quantifiable edge.
It's a divergence, certainly.
It mathematically proves the consensus is systematically underestimating the upper bound of near-term revenue.
Identifying a 0.8-bit divergence simply means your model disagrees with the market. It does not prove your model is correct.
It proves the magnitude of the disagreement in bits.
But how do you mathematically verify that TSMC's capital expenditure is the actual fundamental driver of NVIDIA's revenue, rather than just a coincident indicator fueled by broader macroeconomic liquidity?
That's what step 3 is for.
Because two variables can rise simultaneously without one causing the other.
Absolutely. And step 3 solves the correlation trap through transfer entropy. We discard Pearson correlation entirely.
Because Pearson merely measures if two lines move together.
Exactly. Transfer entropy traces the strict direction of causality. It measures how much the uncertainty in NVIDIA's future revenue is reduced by knowing the history of TSMC's capital expenditure.
Above and beyond what is already known from NVIDIA's own history.
Precisely. And the transfer entropy from TSMC to NVIDIA is 0.35 bits. By stark contrast, the transfer entropy from NVIDIA's own forward management guidance to its subsequent realized revenue is only 0.12 bits.
Wow, only 0.12 bits for their own guidance?
Yes, the mathematics prove that the upstream supply chain forces drive the asset far more powerfully than the company's own internal forecasts.
I say the math, but causality is notoriously difficult to isolate in complex networks.
Not if you measure the directional reduction in uncertainty.
But then serious. If the TSMC capital expenditure data is temporarily distorted by a transient supply chain anomaly, let us say a geopolitical hardware embargo or a localized factory disruption, that 0.35-bit causal link is completely compromised.
We would measure that distortion as it happens.
By the time you measure it, it becomes a ghost signal. The danger of standardizing uncertainty is that you treat a dynamically changing human geopolitical system as if it were a physics equation.
The system is dynamic, and the engine updates constantly.
But if the upstream data is poisoned, it misleads the entire downstream sizing algorithm.
The algorithm demands continuous measurement to detect such poisoning. Which brings us to step 4, scoring conviction through a hidden Markov model.
An MMM, right. A hidden Markov model operates on the premise that the true state of the market is invisible or hidden and can only be inferred through observable outputs.
Yes, The classic analogy is attempting to determine whether it is summer or winter while locked in a windowless room, relying solely on observing whether people entering the room are wearing heavy coats or t-shirts.
A perfect analogy. In our framework, the HMM analyzes the observable price and volume behaviors to infer the hidden market regime.
And what does it detect for NVIDIA?
The model detects that NVIDIA is currently operating in a robust bull regime with a transition persistence probability of 0.88.
So an 88% mathematical probability that tomorrow's regime will remain the same as today's. Exactly. When we intersect the highly persistent bull regime with the phase 1 compression from step 1, the protocol outputs maximum operational conviction.
Maximum conviction. That is the exact psychological state that precedes maximum drawdowns.
Which is why we do not size the position on conviction. Conviction simply grants permission to proceed to step 5.
The stress test.
Step 5 demands that we stress the tail risks using copulas, because normal market correlations are entirely useless during a crisis.
True. Standard correlation measures how two assets interact on an average Tuesday. It fails to capture how they behave when the market floor collapses.
Exactly. So we apply a Clayton copula, which specifically captures lower tail dependence.
Let us clarify this mechanism for a moment. The Clayton copula mathematically isolates the probability that two assets will crash simultaneously, independent of their normal everyday relationship.
Correct. The Clayton copula shows a 0.58 tail dependence between NVIDIA and the broader Magnificent 7 technology basket.
A 0.58 dependence is highly significant.
Yes. And through Vine copula network analysis, we identify Apple as the root node of this dependency tree.
Apple is the root node.
The math tells us that if a systemic contagion event occurs in the technology sector, it will likely propagate outward from an Apple consumer demand shock.
I understand the architecture of the copula, but parameterizing a Clayton copula relies heavily on the look-back window of your dataset.
We use the deepest historical drawdowns available.
But if the past decade of technology sector outperformance lacks a true systemic valuation collapse, your copula is parameterized on minor 10% corrections, not existential market failures.
That's a constraint of reality, not the model.
You are attempting to model a 100-year flood using data from a decade of light rain.
That fundamental limitation is directly addressed in step 6, quantifying the extreme via extreme value theory, or EVT.
EVT, right.
We abandon normal Gaussian distributions, which assume severe market crashes happen once every geological epoch, and instead fit a generalized extreme value distribution specifically to the deepest historical drawdowns.
And the shape parameter for this?
The shape parameter, known as Xi, measures 0.32.
Xi is 0.32.
This value strictly defines exceptionally fat tails. Calculating the univariate 99.9% value at risk gives us a maximum expected daily drop of negative 18%.
An 18% drop in a single day?
However, we then inflate this figure using the copula multiplier derived in step 5 to account for simultaneous network contagion.
Ah, the Apple root node contagion?
Correct. The adjusted copula-inflated worst-case daily loss is negative 25%.
Let me get this straight. So the engine identifies a highly causal, high-conviction setup, but mathematically prepares the operator to endure a sudden one-quarter destruction of the asset's value in a single day?
Yes. And only now do we arrive at step 7, linking all of this to the Kelly criterion for position sizing.
The actual allocation.
The raw Kelly formula, based on our KL divergence edge, suggest allocating 8% of total capital to this position.
8% is massive for a single stock.
Which is why we take that raw Kelly output and divide it by a structural fragility factor of 4.2.
And that 4.2 is derived directly from the extreme tail stress calculated in step 6?
Yes. The final output is an exact, mathematically optimal position size of 1.9%. We have converted an abstract, fundamental theses about semiconductor supply chains into a precise, mathematically defensible allocation.
The mathematics may be defensible, but I must challenge the execution layer here. The math is elegant, human operators are deeply flawed.
The protocol replaces the human flaw.
What happens when NVIDIA runs up 15% over a 3-week period? The mathematical mandate requires the discipline to maintain the protocol, to recalculate the edge, and crucially not to size up as momentum triggers behavioral greed.
The protocol dictates the size. You just follow it.
Conversely, it requires the discipline not to panic sell when the asset drops 12%, keeping in mind that the extreme value theory model has already calculated the worst-case tolerance at negative 25%.
Exactly. You know the boundary so you don't panic.
The protocol assumes a perfectly rational, emotionless executor.
The protocol is precisely designed to function as an emotionless benchmark. Think of it as a commercial aircraft pre-flight checklist.
A checklist.
Yes. A commercial pilot does not skip checking the altimeter or the wind direction just because the weather looks beautiful to the naked eye. The checklist exists not to govern the 99 routine flights, but to ensure survival on the one flight where a missed, invisible systemic variable would cause total catastrophe.
But human pilots make errors too.
Step 3 checks causality, which is the equivalent of verifying wind direction. Steps 5 and 6 run the emergency tail loss scenarios. Step 7 strictly sets the throttle.
Your commercial aircraft analogy fails on a fundamental philosophical level.
How so?
An aircraft operates in the physical realm. It is governed by the immutable laws of fluid dynamics and gravity. Financial markets are governed by human psychology, reflexive feedback loops, and central bank policy.
The math captures the exhaust of that psychology.
The weather and financial markets actively changes its behavior based on how many pilots are looking at the same radar.
Reflexivity.
Yes. If enough quantitative funds utilize similar copula and EVT sizing models, the very act of them mathematically sizing down during a stress event causes the precise negative 25% tail risk you are trying to avoid.
The reflexive nature of markets is exactly why we must pressure test the engine beyond single equities. Having validated the engine on a single asset, we must subject it to complex, cross-domain networks where contagion hides in plain sight.
You're talking about the multi-asset portfolio.
Yes. Let us examine the engine's application to a multi-asset portfolio. Applying Step 1 phase mapping across global macro domains reveals a deeply fractured landscape.
Fractured in what sense?
U.S. equities sit in Phase 1 compression, heavily unified in narrative. Geopolitics, however, is fracturing and expanding into Phase 2 due to escalating trade tensions. Simultaneously, the broader technology sector is in Phase 4 recompression following an earnings cycle.
I have to stop you there. Assessing global geopolitics via Shannon entropy is a massive methodological overreach.
It is quantifying uncertainty.
Quantifying qualitative diplomatic friction, speeches, treaties, unwritten alliances into a neat percentile is an exercise in gross approximation.
We do not measure speeches. We measure the financial exhaust of those speeches.
Which means you're still relying on proxies.
We use highly quantifiable proxies for geopolitical friction. Bilateral trade tariffs, shipping freight rate anomalies across major oceanic routes, and sovereign credit default swap spreads.
Even so, mapping that to equity performance.
Moving to Step 3, we use transfer entropy to map this global network. The data clearly demonstrates that U.S. equity markets are causally driving European markets. Europe is strictly downstream.
That's historically consistent, yes.
In Step 4, the portfolio-level hidden Markov model detects that regime persistence is fading.
Fading persistence.
The probability of the macro regime sustaining itself has dropped from 0.72 to 0.68. Conviction remains present, but its mathematical half-life is shortening.
And what does the protocol mandate when persistence drops?
This fading persistence automatically dictates a reduction to 3/4 Kelly sizing across the board.
Fading persistence from 0.72 to 0.68 is a severe warning sign that the macroeconomic regime is fundamentally unstable. This is precisely where relying on historical data matrices becomes incredibly dangerous.
The protocol anticipates that exact instability in Step 5.
The copula network.
Yes, when we run the Vine copula across the multi-asset portfolio, it identifies the S&P 500 as the root node of global asset pricing. But the crucial paradigm-shifting finding is this.
The correlation breakdown.
The Clayton tail dependence between equities and traditional fixed income bonds sits at 0.35. The mathematics definitively prove that the foundational 60-40 portfolio construction fails exactly when it is needed most.
it fails.
It is a severe lower tail event. Bonds do not act as a ballast. They do not protect equities. They liquidate concurrently.
This brings us to the most critical structural break argument of our era. The transfer entropy and the copula tail dependence you are measuring between equities and bonds were generated during a decade of unprecedented central bank intervention.
The data reflects the reality of the market.
Quantitative easing fundamentally destroyed natural market entropy. Central banks suppressed natural causality and forced disparate asset classes into artificial correlations by flooding the system with liquidity.
The math just measures the current state.
But the traditional inverse relationship between stocks and bonds was broken by policy, not by nature. If the macroeconomic regime shifts permanently into a structurally inflationary environment, your historical copula fittings are mapping the last war.
We only map the realized data.
Treating a dynamic geopolitical macro environment as a closed mathematical system governed by QE-era data is a profound vulnerability.
The protocol does not assume a closed system. It adapts by continuously updating the extreme value theory parameters based on new realized extremes.
What does the EVT show for this portfolio?
For this specific multi-asset portfolio, the monthly value at risk is calculated at a staggering negative 22%.
Negative 22% for a balanced portfolio.
To survive this mathematical reality, the engine forces the portfolio to resize. It mandates a 75% allocation to equities, but crucially, it introduces a 15% allocation to gold.
Because of gold's tail independence.
Exactly, because the copula specifically reveals that gold possesses a tail-independent score of 0.08 relative to the equity root node.
And the rest?
The remaining 10% is held in absolute cash. The engine independently discovers the failure of the 60-40 portfolio and automatically constructs a mathematically superior alternative based purely on tail independence and entropy, bypassing human bias entirely.
A 0.08 tail-independent score for gold assumes that gold will retain its historical safe haven properties during a modern, algorithmic liquidity crisis.
It has historically.
Let us examine the empirical truth. In March 2020, gold suffered a massive initial drawdown alongside equities. Why? Because highly levered funds needed instantaneous cash to meet margin calls, and gold was the most liquid asset available to sell.
It recovered rapidly, though.
Your mathematical copula might identify independence on a smoothed monthly timeframe, but the violent intraday execution reality could wipe out a highly levered operator before the mathematical independence has time to assert itself.
Which underscores the vital importance of the liquidity reserves mandated by Step 7, the 10% cash.
Assuming 10% is enough.
It is based on the math, but let us push the engine even further. Transitioning from highly liquid public markets, we subject the 7-step protocol to its ultimate stress test: illiquid physical business operations.
We are really doing this.
We apply the framework to a physical retail operation, a bubble T chain evaluating an expansion from 5 existing locations to 8.
Applying quantitative finance instruments to a localized retail operation stretches the boundaries of statistical validity, fundamentally.
The math of uncertainty is universal. It doesn't know its pricing bubble T. In Step 1, we evaluate the monthly revenue entropy across the 5 existing locations.
And the result?
The entropy is actively declining, indicating Phase 1 compression. Daily demand patterns are stabilizing and becoming highly predictable across the operating network.
Stable demand in 5 established locations does not mathematically guarantee stable demand in 3 new, untested geographies.
That is why we employ mutual information in Step 2. Mutual information measures how much knowing one variable reduces uncertainty about another.
What variables are you cross-referencing?
We measure a 0.6-bit reduction in daily sales uncertainty when we cross-reference internal sales data with external variables like localized weather patterns and social media velocity.
0.6 bits.
Step 3 then traces the specific causality. Transfer entropy proves that Instagram engagement dynamically causes localized foot traffic, generating 0.3 bits of predictive power.
0.3 bits just from Instagram?
This is not a guess. This dictates with mathematical certainty that the expansion marketing budget must be strictly allocated to that specific platform rather than broadly distributed across traditional local media.
The noise-to-signal ratio in hyperlocal social media data is astronomical. A viral post generated by a bot network in a different state could easily spoof the localized transfer entropy measurement.
The protocol naturally filters out superficial noise during the tail stress test. In step 5, we calculate the Clayton tail dependence across the operational network.
Okay, let's look at the tail dependence.
Across the 5 existing locations, tail dependence is 0.45. If a local supply chain disruption occurs or a localized economic downturn hits, the stores suffer simultaneously because they draw from heavily overlapping customer pools.
Right, they cannibalize or crash together.
However, when we project the copula into the demographics of the 3 new geographic zones, the tail dependence drops drastically to 0.22.
That's a significant drop.
Contagion risk is mathematically cut in half by expanding into non-correlated neighborhoods.
Here is where the mathematical edifice risks complete collapse under its own weight. Step 6 requires quantifying the extreme through extreme value theory.
Which we execute.
Let us be methodologically precise here. To generate a robust, generalized extreme value distribution, specifically the shape parameter z, quantitative literature dictates a minimum of 200 discrete tail observations.
Standard EVT constraints, yes.
How can a 5-location bubble tea chain provide 200 independent, severe tail events without having gone bankrupt multiple times over?
We use proxy metrics and high-frequency foot traffic data to simulate the tail events.
You are substituting robust statistical populations with severe low-N environments. Generating a shape parameter from such a sparse localized dataset risks offering a highly dangerous, false sense of precision in an environment that is dominated by unquantifiable localized variables.
Like what?
Like foot traffic disruptions, sudden municipal zoning changes, construction blocking a street.
Even a proxy EVT calculation derived from sparse data is vastly superior to the traditional alternative, which is expanding a business based on pure operational hubris and gut feeling.
Is it?
Yes. Our adjusted EVT projection calculates a worst month localized revenue decline of -48%.
-48%.
This mathematical reality is drastically worse than the operator's intuitive, emotional definition of a normal bad month, which sits at -25%. Step 7 processes this severe discrepancy.
The Kelly adjustment.
Because the tail risk is nearly double what intuition suggests, the adjusted Kelly formula dictates deploying only 60% of the available expansion capital, strictly mandating a 40% operational liquidity reserve.
So they don't open all 3.
The definitive output of the engine. The chain must only open 2 new locations, not 3. The measurement forces operational caution. It proves its value, even with imperfect data, by systematically preventing the single most common failure mode in physical business, scaling beyond the mathematical limits of capital survival.
It forces caution in this specific, convenient example. But we must consider the inverse vulnerability.
Which is?
What if the sparse data had randomly output an artificially mild tail risk? If the limited dataset lacked a true exogenous shock, the exact same mathematical mechanism could confidently authorize catastrophic overexpansion.
The system inherently skews conservative on low-end datasets.
When you apply macro-level statistical instruments to micro-level operations, the high variance in your initial inputs can completely invert your final outputs. You are trusting a formula that is blind to its own sample size limitations.
The formula is not blind. It is governed by the overarching philosophy of the system. This leads us to abstract these specific worked examples from NVDA to the 60/40 portfolio, to the physical retail chain into the universal laws that govern them.
The Information Edge Manifesto.
Exactly. We distill the entire season's analytical journey into the Information Edge Manifesto, comprising 7 immovable principles.
Let us rigorously outline these principles then.
Principle 1 states you can never mathematically earn beyond what you know. This is the absolute Kelly limit.
Understood.
Principle 2, derived directly from Shannon, asserts that the market for information is the actual market. Asset prices are entirely downstream of information flow.
Also sound.
Principle 3 mandates that we must measure how wrong we are
not how right. Utilizing KL divergence. Principle 4 establishes that the direction of cause is vastly superior to correlation, proven continuously via transfer entropy.
We've covered causality, yes.
Principle 5 dictates that subjective conviction must be mathematically earned through the intersection of hidden Markov models and entropy phase compression. Principle 6 defines true safety as the rigorous stress testing of extreme, invisible tails using copulas and EVT.
And the final principle?
And finally, Principle 7 serves as the ultimate governor of the system. The edge naturally decays. Therefore, you must keep measuring.
I want to deeply analyze Principle 3.
The KL divergence principle.
The mandate to minimize wrongness through KL divergence rather than maximizing rightness runs counterintuitive to almost every traditional heuristic in capital allocation.
But it's mathematically sound.
In highly volatile venture markets or asymmetric trading environments, legendary returns are generated by being spectacularly right on a deeply contrarian, extremely low probability event.
But you have to size it correctly.
Minimizing the statistical distance between your distribution and the market's consensus distribution might protect you from catastrophic error, but it fundamentally risks anchoring you to the herd. It leads to a portfolio that simply tracks the index.
It doesn't anchor you to the herd, it calibrates you.
I question if minimizing wrongness is truly superior when extreme outlier rightness is the sole generator of venture scale returns.
Minimizing wrongness is mathematically superior precisely because it forces continuous calibration over reckless speculation.
KL divergence does not punish an operator for holding an extreme, contrarian view.
It forces that view to remain close to consensus probability.
No, it punishes the operator for assigning an incorrect probability weight to that view relative to the market's pricing. It ensures that when you do take a highly asymmetric, low probability position, your expected value is positive and your edge is explicitly calculated in discrete bits.
Rather than relying on blind faith.
Exactly, rather than relying on blind faith or narrative intuition.
Which brings us to the profound meta-risk inherent in Principle 7. The edge decays, keep measuring.
The ultimate governor.
Acts as the silent, ruthless governor of the entire seven-step framework. The protocol is a continuous, relentless loop of observation and adjustment. It is not a monument to be built, parameterized, and admired.
No, it's a living engine.
The absolute moment an operator or an automated algorithm stops questioning the integrity of the underlying inputs, the protocol devolves into a historical narrative.
True.
The information edge evaporates. When that happens, the Kelly fraction, which inherently assumes a positive active edge, inverts. It transforms from an instrument of optimal compounding into a weapon of rapid wealth destruction.
That is not a flaw in the system. That is the thermodynamic reality of the universe we operate within. And here we arrive at the profound emotional synthesis of this entire analytical framework.
The final synthesis.
The 7 steps we have debated today are not merely independent mathematical instruments played in sequential order. They are all measuring the exact same underlying physical quantity: information.
Just at different scales.
They simply measure it at 7 distinctly different scales of resolution. Claude Shannon saw this foundational truth in 1948 when he linked telecommunications to entropy,
Edwin Janes formalized it in 1957.
proving definitively that statistical mechanics and physics and information theory and mathematics are governed by the exact same equations. Ilya Prigogine extended it further in 1977, demonstrating that complex systems operating far from equilibrium, like biological organisms or global financial markets, self-organize and survive solely through the continuous exchange and processing of entropy.
The ambition to link the daily expansion of a local bubble tea chain to the thermodynamic self-organization of complex, far from equilibrium systems is incredibly vast.
But it holds mathematically.
Yet if we are to accept that Prigogine's principles fundamentally apply to human economic behavior, we must also accept the ultimate inescapable consequence of thermodynamics. Entropy always increases.
Yes, it does.
Order is inherently temporary. Information is fleeting. Measurement is not a final destination. It is a constant, exhausting fight against systemic decay.
Exactly. The protocol provides fundamental analysis, technical analysis, and portfolio construction with a unified, common language measured purely and objectively in bits.
It translates uncertainty into bits.
It translates the terrifying abstract concept of uncertainty into a common, actionable mathematical output measured in position size. Every single step in the 7-step protocol reduces uncertainty by a precise, measurable quantity.
And that reduction,
The total sum of that reduction, the delta between raw market chaos and structured probabilistic knowledge, is the exact definition of the edge.
I acknowledge the formidable intellectual power of standardizing uncertainty into a single cohesive metric. It removes the behavioral noise that destroys most allocators.
It does.
However, the final warning remains absolute. The act of measurement must never, ever stop. A mathematical model is merely a snapshot of a highly fluid reality.
A snapshot that must be continuously refreshed.
Relying on an outdated measurement is infinitely more dangerous than operating with no measurement at all. It provides the operator with the psychological comfort of rigorous quantitative analysis, entirely stripped of the empirical truth of the present state.
You cannot eliminate uncertainty. The human attempt to do so through complex narratives leads only to fragility and ruin. You can only measure it, and the measurement itself is the edge.
This is the Research Desk officially signing off.